Hello, my name is Bob Brooks, and I am the host of the Prudent Money Radio Show. Listen, I so appreciate you taking the time to learn about the Shemitah, what it is, and how it could be a significant turning point in our markets. Now, when I say significant turning point, that could be positive or negative. We're going to take a look at this from every angle, focusing mainly on how this affects markets and economies. First, a little bit of housekeeping. I'm in no way intended for this presentation to be any type of advice or any type of guidance. I'm not trying to forecast anything. I think there's plenty of forecasting going on when it comes to this fall. Draw your own conclusions instead of being told what's going to happen. In my opinion, there's been a great deal of sensationalism surrounding the fall, surrounding the Shemitah, and it's my hope that you walk away with a better understanding of how this 7-year cycle has affected markets and what could the possibilities be, both positive and negative. Now, I'm going to make a deal with you. If you will banish the thought or the notion that you can't understand numbers, that the stock market stuff is just too hard to understand, then I'm going to promise not to speak financialese. Financialese is a term I coined a while back, and I call it and define it as the language of investment spoken in such a way that no one understands it. In my business, people tend to speak in terms and talk about technical things that people can't even remotely understand. So I'm going to work real hard at not doing that, but you can walk away with a better understanding of what's really going on. Of course, all of this comes from Rabbi Jonathan Cahn's book, The Mystery of the Shemitah. And his first book, The Harbinger, really laid the groundwork for this latest book. Now, when discussing the Shemitah, there are two aspects here to consider. First, there's the biblical aspect, and then there is the aspect of the 7-year cycle. Of course, they're both connected, but we're going to talk a little bit more about how the 7-year cycle has exerted influence over the markets and the economy. It's often been said that God is a God of patterns. Well, the stock market is also all about patterns and numbers have significant meaning in both the Bible and the market. So we'll start with a general explanation of what the Shemitah is. The Shemitah is a historic 7-year cycle, and in the Bible, the people of Israel were commanded to let the land rest every 7 years. There was to be no sowing or reaping. It was a symbolic time of stewardship, signifying that everything belonged to God. Just like the Sabbath day is the 7th day and the day of rest, well, the 7th year of the 7-year cycle was referred to as the Sabbath year or the Shemitah. The failure to observe these Sabbath years was one of the reasons cited in the Scriptures for why the Jewish people were exiled to Babylon. Additionally, on the last day of the Shemitah year, the people of Israel were instructed to release or relinquish debts. Rabbi Jonathan Cahn, in his book, The Shemitah, describes it this way. The Shemitah cleanses and wipes away, ends and balances, levels accounts, and nullifies that which is built up in the previous years. A massive cleansing of the financial and economic state. It ends entanglements and brings release. Its release applies not only to the land and to the nation's financial accounts, but also to something much more universal. The Shemitah requires the people to release their attachments to the material realm, their possessions, their finances, their real estate, and their claims and pursuits concerning such things. It is the breaking of bonds, and those who release are likewise released, no longer possessed by their possessions, but free. The Shemitah is a reminder that God is the source of all blessings, spiritual and physical alike. But when God is removed from the picture, the removal of blessings will ultimately follow. According to 2 Chronicles, the mystery of the Shemitah was operating behind one of the most pivotal events in world history, the destruction of the kingdom in 586 BC. It can be a holy year of blessing if observed, or a year of judgment for falling away from God. It is an act of judgment by God on a country that has divorced itself of God. Of course, this is Jonathan Cahn's, this is all about his book in the interpretation of the Shemitah. God's judgment of America. The intent of this presentation is not to talk about the biblical aspect of it, although Jonathan Cahn, Rabbi Cahn, covers it in great detail, and I would encourage you to get the book so that you can read all about the biblical aspect of this. What I want to do today is talk about the importance of it from a market standpoint, and I'm going to show you information that I don't think that you're going to find anyplace else. I haven't found anybody else writing about this or tying the Shemitah into specific and historical market days. Now, the Shemitah is a symbol of stewardship. The Shemitah is a year of blessings. The Shemitah can also be a judgment. And according to Kahn, two keys to the Shemitah. The first, the Shemitah bears consequences that specifically affect the financial realm and financial and economic realm. The effects of the Shemitah bear key similarities to the effects of an economic and financial collapse. That brings what was happening to the Israelites into modern times, that it looks like economic and financial collapse. So once again, the objectives of this presentation, to make you aware of this 7-year cycle and add some additional interpretation of it. Like I said earlier, there can be a positive outcome that comes out of this, to give you another potential option beyond the prediction of doom and gloom, to help you know what to do in the event that the 7-year cycle does exert its influence on the markets. We're going to spend the last part of the program talking about that so that you can build your own plan B. Now, why is this 7th year so important? In my studies and research of patterns of markets and what has happened in the past, I've found a lot of tie-ins. And this particular Shemitah year should determine whether or not we are in a long-term bear market cycle, or we actually started a new long-term bull market cycle. This is significant, and I'm going to get into the details of this and break it down. And when we talk about a long-term bear market cycle, we're talking about a long-term period of ultimate frustration for investors, where investors either make nothing or they lose something instead. In a long-term bull market cycle, of course, is a good time to be in the market. And I really believe, based on the research that I've done, that this is going to determine and answer the question, did we start a long-term bear market cycle in 2000, meaning we're coming back to it, or did it end in 2009 and we started a new long-term bull market cycle? And we're going to get into that and talk about that. This Shemitah year also could complete a 15-year pattern in the Dow Jones Industrial Average, repeating an exact same pattern that happened in the 60s and 70s, and there's a real tie-in here. Now, this, once again, could either be a negative or a positive. Finally, this Shemitah year could also determine if the 49-year cycle, the 7 times 7, and 49-year cycle happens before the year of Jubilee, if that's going to exert influence over the markets. Now, let's take a look back at prior Shemitah years. Now, the current Shemitah year is September 2014 to September 13th, 2015. Now, past Shemitah years, let's go through them. 2008, we saw the collapse of Lehman Brothers and almost the financial system. 2001, the biggest terrorist attack on American soil. 1994, Rabbi Kahn describes it as the bond market was crashing. I was managing money in 94. I don't really remember it crashing. Now, there was problems in the bond market, but also that year was the precursor to a 6-year bull market run, the final phase of a very long-term bull market. So that some good actually came out of that particular year. And then there was 1987, the second largest stock market crash in history. 1980, the start of a 27% decline in the stock market. 1973 is a significant year. We'll come back to that, but it's the beginning of a 48% decline in the stock market. 1966 was an 8-month, 22% decline in the stock market. 1959, a 13% drop in the stock market, which is really a non-event. I mean, we've already had that this year. 1952, a non-market event. 1945, a non-market event. 1938, the stock market declined 50% in 7 months. 1931, the stock market already in a huge bear market. Now, 1924 is fairly interesting because that was a time that was the stock market was in a huge bull market, the roaring 20s between 1921 and 1929. Now, once again, I'm just focusing completely on the markets and what could happen in the markets. These years that I call non-market event years, granted, something probably didn't happen in the market, but there were, as Rabbi Kahn writes in his book, there were significant events that took place that shaped the direction of America, which is why you really do want to read this book. Now, the top 5 largest bear markets since 1929, I break it down here as to what was a Shemitah year and what wasn't. 1929 and 1937, non-Shemitah years. 73, of course, was. 2000 was the beginning, and 2007 was the beginning of a Shemitah year as well. I looked at the Shemitah years and the business cycle dating back to the 1800s, and looking at and taking the Shemitah years and dividing them in one of four categories. A recession started in a Shemitah year, a recession ended in a Shemitah year, a recession was occurring in a Shemitah year, there was no recession associated with the Shemitah year. 70% of the time, a recession was associated with a Shemitah year. Now, the significance of 7, the most referenced number in the Bible, it means to complete, and I say that it's the 7 is the completion of a cycle, and there is something to the 7-year cycle. And then there's the 7-year and 7-month stock market top. Now, this was something that Jeffrey Cooper at minionville.com, he introduced this. This is not from my research. And what he showed was this chart of the stock market. You have point 1, point 2, and you can see point 3. Point 1 was the top of the bull market right before the 2000 to 2002 technology bust, which was a bear market. And point 2 was the top of the real estate market before we fell into the financial crisis and that big bear market. Between point 1 and point 2, two significant tops of the market was 7 years and 7 months. Now, if you fast forward to today, May 20th was the top in our market thus far, and this is obviously a dated webinar. Things could have changed by the time you're listening to this. But so far, as he points out, it's 7 years and 7 months from point 2 to point 3. It's just amazing when you see how these patterns and these numbers line up. Now, to understand how the market works, you really have to understand the rhythm, what I call the rhythm of the market. Markets go from being imbalanced to being out of balance back to being in balance. Markets get out of balance during long-term bull markets. When the market's going up, it gets way out of balance, and then long-term bear markets, through loss, brings them back into balance. Now, history shows that the market goes through a series back and forth of long-term bull market cycles to long-term bear market cycles and back and forth. And this 7-year cycle can actually be a balancer. Now, what the industry shows you is this picture. This is the stock market, Dow Jones Industrial Average, from 1900 all the way up to today. They look at this picture and they'll show it to you and they'll say, look, you have nothing to worry about. Stay invested. Never change your investments because, look, the market always goes up. And you're going to be in good shape. You're a long-term investor. But if you take it and you break it down, you'll see this. 1900 to 1921, not a great time to be in the market. Market was all over the place. If you would have just bought and held through that period, it wouldn't have worked out so good for you. 1921 to 1929 was a great time to be in the market, but you see the market got way out of balance in the roaring 20s, resulting in 1929, the biggest stock market crash on record. 1929 down to 1942. That was a miserable time to be in the markets. Then 1942 to 1966, another great time to be in the market where great wealth was created, and of course the market that got way out of balance. And then you had this, 1966 to 1982, where the market went back and forth over a very long period of time, getting back into balance. And then you had the great bull market, 1982 to 2000, and you can see how the market just went straight up. Now, take a look at this chart, and once again, what's the deal? I'm going to break this down for you, but you can't get intimidated if numbers are not your thing, because you really got to understand this for it to make sense. This takes the pictures you just saw and lays them out from period to period. So you see where it goes from a long-term bear market to a long-term bull market, back to a long-term bear market, back to a long-term bull market, and it switches and goes back and forth. You can see the number of years these periods have lasted. Well, 1982 to 2000 was a long-term bull market. Then we started in 2000 what looked to be a long-term bear market. But the question is, did that long-term bear market conclude in 2009, or is it still there? And it's a significant question, and what I'm going to show you in a second is going to show you why the Shemitah year could end up determining that question. Because if we're still on the left-hand side of this chart, if we're still at 2000 and we still have maybe another 5 years to go, that would suggest that we've got a very rough market ahead of us. But if we stopped in 2009, that means we probably have another bull market that could last 7 to 8 years. And it's a very important question to answer. Now let me show you how I come to that. The average number of Shemitah years in a long-term bear market cycles, and this is dating back to 1881, except for one period, was 3. Thus far, starting in 2000, if the theory is that we are still in a long-term bear market, then that 2015 would go up top. We would have 3 Shemitah years, and the long-term bear market cycle would come to a conclusion at some point in the next 2 to 3 years. Same thing for the long-term bull market cycle, though. The average of the long-term bull market cycle's average number of Shemitah years is 2. You can see that has happened in every cycle except for 1. And if that is the case this time, 2015 would be the first of 2 Shemitah years starting in this cycle. So this is pretty significant to see going forward. Are we about to run into trouble, which the Shemitah year would mark that, or are we about to go into the next phase of the bull market, which the Shemitah year would mark that particular turning point as well? Now let's talk about the 7-point megaphone top. Now this is a pattern. I told you the market's a market of patterns. This is a pattern that the Dow Jones Industrial Average is actually going through right now. If you look at this, the first one where it says megaphone pattern during the 70s, and they call it a megaphone because as you draw the 2 outside lines, it's in a shape, somewhat of a shape of a megaphone. So they call it the megaphone pattern. I add to it the 7-point because it does have a significant number of points in it, and it just so happens once again to be 7. So you see at the bottom, it went from point 1 to point 2, up to point 3, down to point 4, up to point 5, down to point 6, up to point 7, and then the pattern completed itself and the market went up. We have the exact same thing playing out here. We had point 1 down to point 2, up to point 3, down to point 4. Now could we be at point 5? And what I want to suggest is that the Shemitah year could define point 5 if that is exactly what's going on. Now, here's where this gets significant. Point 5, obviously, would, if that is a point 5, would be the Shemitah year. Point 5 in the 70s was 1973. It too was a Shemitah year. Now, point 1 was a Shemitah year in 1966, and point 1 was also a 49-year cycle year. Now 49 years, 7 times 7, precedes the 50th year, which is the year of Jubilee, and Rabbi Kahn gets into all the details of that in the book. So point 1 in the 60s, 1966, was a Shemitah year as well as a 49th year, 7x7 cycle. And if point 5, 2015, if that is point 5, would be 49 years removed from point 1 in 1966. Said another way, if today, 2015, is the next 49th year following 1966, and this next year is the year of Jubilee. Could it be that point 1 in the 1966, which started a significant megaphone pattern, 49 years later, you have point 5 ending a second major megaphone pattern? Because point 5 to point 6 is decline, it rising up to 7, and then you're out of it. So to me, point 5 is the ending of the megaphone pattern. So could it be that you had the megaphone pattern in the 70s start with a 49th year and end the second one in point 5 in a 49th year? I realize that's a lot to take in, so here it is written out. The significance of 0.5 and the 49-year cycle. 1966 was the beginning of the megaphone pattern in the 60s. 1966 was a Shemitah year. 1966 was also a 49th year, which precedes the year of Jubilee. 1973 was a 0.5 and a Shemitah year as well. 2015 is a Shemitah year. 2015 is 49 years from 1966, and 2015 precedes the next year of Jubilee. If 2015 is 0.5, could the beginning of a megaphone pattern and the ending of the next one be separated by the 49-year cycle? So I think you'll agree it's amazing how all of these numbers line up. So as a review, we have two significant events that this Shemitah year could define. First, whether we're still in a long-term bear market or not. Second, whether the 49-year cycle is going to exert its influence on the beginning and ending of two separate major megaphone patterns. Now, let's talk about the current pattern of the S&P 500. That was the Dow Jones Industrial Average. And on a short-term basis, the Dow Jones Industrial Average is kind of going through the same pattern as the S&P 500, but the S&P 500 is a little bit more clearly defined. Now, here's a significant statistic. The top 5 bear markets since the 1920s was 1929, 1937, 1973, 2000, and 2007. All 5 of these bear markets were preceded by a variation of the same pattern seen in today's stock market. Now, fortunately, this is something that you can actually visually see. Between 2000 and 2002, you see up at the top left-hand corner, the market went back and forth over a period of time between those two lines in a channel, and then it fell out of the channel and into a bear market. You can see the same thing happen in 2007 to 2009. It went backwards and forwards in a channel and then fell out of the into a bear market. Here's the picture today. In that channel since November of last year, and now you can see this is towards the middle to the end of August, where the market fell forcefully out of that channel into a pretty large decline, and that's where we are right now. Once again, this is dated. If you're listening to this in October, you already probably knew what happened. This is the way it looked in the other three bear markets that started. 1929, you can see that channel there in 1929, but instead of just falling out of the bottom of that channel, it went up through the top, then it crashed. Same thing in 1937. It went up through the top of that channel, then it crashed. And then you can see the same thing in 1973. Remember our 0.5 in the megaphone pattern of the 60s and the 70s. It went in that channel, broke out of that channel, and then went into a 48% decline. So what are some takeaways? Long-term bull market cycle or the completion of a long-term bear market cycle. It's significant because this means, you think about that chart again on the left-hand side and the right-hand side. If we're still on that left-hand side, we've got a very tough market ahead of us. And if we're still on that left-hand side, it needs 2015 to be within the confines of that long-term bear market. But if we're on the other side, on the long-term bull market side, that means we have a very nice market ahead of us. And I believe that this particular Shemitah year is going to determine that. Keep in mind that predictions and forecasts can get over-sensationalized. In fact, I've often thought that forecasts and predictions, the more over-sensationalized, the better, because if they come true, then you are all of a sudden a prophet. But they over-sensationalize these forecasts by using words such as crash and crisis, and of course that has an effect emotionally on people. But you got to know something, that yeah, there are some legitimate forecasts out there that are not so positive. But then again, there's a lot of gloom and doom marketing full effect. We have viral videos going through email of past politicians getting up talking about the end is near. You got to know that they're all about selling things. They're about selling newsletters. They're about selling books. And once again, the over-sensationalism of these predictions is going to sell many more subscriptions than if it wasn't sensationalized enough. But the reality of it is we have a hurricane-type environment in the markets right now. If you live in Florida, you are on guard and ready just in the event that a hurricane comes, because the waters are warm, the patterns are ripe to produce hurricanes. It is hurricane season. I would suggest the same thing is happening with our markets right now. So you have to be on your toes, and you have to be ready and prepared for anything. But keep in mind that there's one thing that's true about this market. The market is always unpredictable. Everybody could be expecting one thing, and just know that when everyone expects something to happen, it rarely does, and then the market throws a curveball, or it could be so obvious, and these are just happen to be signs that we're discovering that are pointing to something ahead that would keep us locked into a long-term bear market. Regardless, it doesn't matter. Have your plan B ready ahead of time. As a prudent steward, you're a risk manager, and being a risk manager means to have that game plan in place. Now, let's talk about what works. What do you do? How do you put together a plan B? Well, let's look at all the possible places you can put your money. There it is right there. I'm sure I'm missing a few, but that's most of it. Obviously, if you're needing a plan B, stocks of large, medium, small cap, most stocks are not going to be a great place to be, so you got to do that a little bit differently. Gold and oil, those are interesting investments just because they've both been through big bear markets. Whether they're still in the bear markets or not, whether they can do well when the market's going down, if the market's going to go down, that's a question to be answered as well. So there's a big question mark on that. Then there are bonds and fixed income. I might be as worried about bonds and fixed income because of the way people look at it. People look at bond funds as safe investments. And I got to tell you, bond funds can lose money. Bonds represent debt, and debt can be defaulted on. You can lose money. And so bonds are not a safe place to be. They carry their own set of risks. Now, you're looking at things like junk bonds, high yield bonds. I mean, that's real risky bonds, real risky debt, and a lot of people have used those because they're trying to get higher yield. But you got to know that is, if you're holding a bunch of junk bonds, municipal bonds can also be a problem too, because municipalities are running into financial crisis. Take, for example, the state of Illinois, which is in very bad shape. They just voted to cut the benefits of retirees because they are so underfunded in their pension program. In fact, a story that came out the other day that a guy won $250,000 in the state lottery, and instead of receiving a check, listen to this, he receives an IOU because they don't have the money to pay him. That's pretty bad. And then there's alternative investments. Now, let me say this as my disclaimer. I'm not saying this is a slam dunk and that alternative investments are going to work every time. Alternative investments have worked in the past and have been a good option for difficult markets because they are, as they suggest, they're an alternative way of investing. They are non-correlated to the market, which simply means that they're not designed to move in the same direction as the market moves. And so this can be a good type of investment to have inside of your portfolio as an alternative. Now, there's some things you need to know about it as a word of caution. Number one, not all alternative funds that are classified as an alternative investment are actually alternative investments. I've come across quite a few funds that should have no business being classified as an alternative investment. So you really need to make sure that they are an alternative investment by definition. Second, these funds, most of them, are not buy and hold type funds. They have to be managed and actively managed. There are some that are really pretty good buy and hold funds, but there's very few. So these really need to be actively managed, and because they have their own risk level as well. Now let's talk about putting a plan B together. This is just to give you some ideas, to get you thinking about some things that you could do. These are very general, very global type ideas. I think that the more complicated that you get investment ideas, the more likely you're probably not going to look into it, which I don't blame you. So we're going to keep this very global, very generic. This, once again, is not intended to be considered as advice. This is just some ideas that you can implement. Let's start off with the 401k plan because that is where most people have their assets. And by the way, you can combine a lot of these strategies together. The downside with 401k plans is that what you have is primarily stock funds and bond funds. You rarely see alternative investments in 401k plans. You just have traditional stock funds and bond funds. That's tough when you're trying to look for a place to hide or you're looking for a place to diversify that's, once again, non-correlated. So look at it this way. Add up the percentage that you have invested in stock funds. That's step one. And let's say that you have 80% invested in stock funds. Then you're taking 80% of the market risk. Maybe you're not comfortable with that. Maybe you think, wow, 80%. I don't know that I want to be taking that much risk. Maybe you're more comfortable with 30%. So you dial that down from 80% to 30% invested in stock funds. And that can give you kind of a barometer of how much market risk you're taking. Now, what do you do with the rest of it? The rest of it, and unfortunately, the only thing left in most 401k plans are bond funds. But you've got to be careful. Remember, we talked about there's a level of risk with bond funds. The things that you want to look for are short-term bond funds, looking for stable value funds that they don't earn very much, but at least they're stable value, or they're meant to be. Keep in mind something, that I think it's a mistake to look at a fund and say, okay, because that fund did this back then, it's going to do the same thing in the same environment. That might be a little bit of a trap you got to be careful about because, like I said, things are out of balance today. So make sure that you always understand there is no slam dunk. B, things can change as we've seen in the past. So stable value, any of these fixed type, guaranteed type products could be something that you could consider. And once again, be careful as you select bond funds and make sure that you're not increasing your risk by using them. Now, what about your individual retirement accounts or your general investment accounts? Now, with this, you have a lot more options. You're not so restricted like you are with the 401k plan. So first of all, you could take the 401k plan approach where you're looking at what kind of percentage that you want to invest into stocks and call that the percent of risk that you're going to take. So you have 20% invested in stock funds. That means you're taking 20% of the risk of the market. You could take that approach, the same approach, with IRAs and what you're doing. Or you can use low beta funds. Now, I've talked about this in the radio. Beta is a measure of risk. A beta of 1, this is very simple to understand. A beta of 1 means that mutual fund is taking 100% of the stock market risk. So if the market goes down 50%, that fund is probably going to go down close to 50% as well. A beta of 0.5 means that fund is taking 50% of the stock market risk, 50%. So really anything under 1, you start to reduce your risk level. If you go over 1, say a 1.5, 150% of the stock market risk, wouldn't you want to know if your fund is taking more risk than the market's taking? So this is a good way to measure it. Now, what I'm about to say, my disclaimer to this is that, once again, it's not saying that this works every single time. With the research that I've done on low beta funds, I have found that if they're a true low beta fund, the losses were not that bad, and take the financial crisis, for instance, and they made it back up very quickly. And so that's some of the characteristics that I found in my research. Having said that, that doesn't mean necessarily that they're going to repeat that scenario again. It's just what historically that is what a good low beta fund has done. So let's mix some of these up. You could use low beta funds. You figure out how much market risk you want to take. Say you want to have 40, 50% invested in the stock market, and then take and invest that 40 or 50% into lower beta funds. So you can mix these approaches up. And then there is active management with alternative funds. We talked a little bit about alternative funds a second ago. Those have to be managed, and you can designate to somebody, hey, you take care of this, you manage it, you know what my risk level is, manage that account for growth and for risk. So that's also an approach that you can take. One other thing that I didn't have up here You could take part of your portfolio if you just wanted to buy and hold, and add a couple of good alternative funds in there as another way to diversify out risk. So these are just some ideas. These are some of the things that you can do. Now, how about some resources? I started the Prudent Money Radio Show, or took it over and changed it to the Prudent Money Radio Show back in January of 2002, very long time ago. And one of my chief goals is to build resources that you can access that don't cost you anything. So I can help you in one of two ways, either indirectly or directly. Indirectly, there's a section at my website, prudentmoney.com, called the Ask Bob section, and you can go send a question in. Now, it doesn't go into a big dark hole. I actually do answer the questions, and I do send back feedback. If I can't help you through the Ask Bob, I can definitely send you to another resource that can help you. So that's one way of getting information at the Ask Bob section. Then there's the Prudent Money Radio Show. It airs Monday through Friday, and you can, if you're out of the Dallas-Fort Worth area, you can listen online at prudentmoney.com, or you can listen live 91.3 FM, 97.5 FM, and 99.9 FM, all in the Dallas-Fort Worth area. It just depends on what section of the Metroplex you're in, whether that frequency works. Then there's a stock market e-letter. I write a 4-page letter to my clients every 2 weeks. I take a scaled down version of that, not as much information, and I put it into this free stock market e-letter, and I send it out to a subscription base. I don't really market this very much or talk about it. I mention it on the radio every once in a while. If you want to be on that, you can go to you can send me an email, bob@prudentmoney.com, and tell me that you want to be put on that stock market e-letter. Then there's the weekly Prudent Money e-letter. That's something we publish and send out every week, and a good way to stay connected with what I think is the information that you need. And then there's the podcast. We podcast every single program. I know a lot of people listen to the podcast, and that goes on iTunes. You can get more information of that on the prudentmoney.com site. And then there's the blog, and I think the blog is going to be important going forward because that's where I'm going to include updates to all the information that we have talked about on this webinar. I'm going to update the charts, update the movement of the charts, and we're going to try to figure out where this road is leading so that you can have a little bit better of an idea of maybe what kind of decisions you need to be making. So that's all at the website, prudentmoney.com. How about some final thoughts? You know, every time I think of the phrase final thoughts, I think about maybe the first or the second time I ever did the radio. I did it with Don Spear, and Don is how I got into radio. He's such a blessing to me, and he's the one who mentored me and really created the opportunity for me to get on. And so I've got this script in front of me, and I'm reading through this script, and I'm so glad that my part's over with. I was so nervous, and Don's just doing a beautiful job, and I'm watching the clock tick down, and we get down to the last 30 seconds, and he looks at me and he says, in this great radio voice, he goes, "Bob, final thoughts?" And I think to myself, final thoughts? I have nothing written down for final thoughts, but I do have some final thoughts for you. I look at where we are today as on the road to the new normal. There was the pre-financial crisis time in our history. Then there was the financial crisis, which changed the landscape of things. And then there's the aftermath, where we are trying to discover what's the new normal. We are without question in a period of time that is unprecedented, I think, in many ways. Thus, you have to think differently, and I believe handle money differently, especially your investments. Then you have the 24 news cycle, which really shapes and defines how we think. Additionally, you have an over-sensationalized news cycle with predictions and forecasts that make you take a step back wondering if you're doing the right thing. The reason for producing this webinar is to show you many different ways to look at this 7-year cycle and to make sure you're aware of it. There is, without question, something to it. At the same time, no one can predict what an unpredictable market is going to do. All we can do is watch the road signs to make sure that we're on the right journey and not about to get lost. It is my hope that you can take this information and use it somewhat as a filter when you're hearing all these predictions of what could happen. Regardless of all that is happening, it doesn't change one thing. As prudent stewards, we have to be good risk managers. That means it is important to have a game plan or a plan B in place in the event that you need it. It is my hope that you walk away with some ideas and strategies that you can use to help have that plan B in place, in the event that you're going to need it. I would suggest the jury is still out. Who knows what's going to happen? But if I can be of any help to you in any way, whether directly or indirectly, please utilize my contact information. That's what I'm here for. And this is important, updates to this research and information will be posted at prudentmoney.com on the blog, and make sure you're signed up for the Prudent Money e-letter, which I publish every single week. So are the signs too obvious forecasting the next move, or is the market going to throw a curveball while everyone is looking for something else? Stay tuned, and we can find out together. Thank you for your investment in time, and keep the faith.